Imagine your bank like a private club with a secret VIP list. Same building, same counter. But some people walk in and get everything waived, while you get hit with a $35 fee because your paycheck landed 2 hours late. That isn't bad luck. That's the business model. They don't need you bankrupt. They just need you close to the edge. So every small mistake turns into revenue. I'm Miles. And if you stay to the end, you'll see banks have very real classes based on net worth. And they change how they treat you the moment you cross certain numbers. I'll break down the 3 tiers, the math behind each one, and why the system is designed to keep you exactly where you are. Here's the key stat that exposes the whole game. 80% of overdraft fee revenue comes from just 9% of customers, which means this isn't a service. It's targeted extraction. In some cases, a $24 purchase can behave like a 16,000% APR trap. Just because you didn't have a cushion, this is entertainment, not financial advice. Now, let's go straight to what banks never say in their commercials. Here's the cold stat. Roughly 80% of overdraft fee revenue comes from just 9% of customers. That means this isn't service. It's a business model aimed at a small group stuck at the edge. Paychecks landing late, balances sitting low, and one tiny timing mistake turning into profit for the bank. In 2024 alone, banks collected about $12.1 billion in overdraft fees, and most of it came from people who could least afford the hit. Meanwhile, if you have $1 million, you get treated like first class, a personal banker, near zero fees, and cheap borrowing for luxury purchases. Same bank, same building, 2 completely different worlds. From here, we're going to map banking into 3 net worth tiers. Starting with the tier banks, monetize the hardest. Tier 1 is under $30,000 in net worth, and I'm going to call it what it is: the struggle tier. This is where banks often make the most money per customer, which sounds backwards, but it's perfectly logical for profit. The median transaction that triggers an overdraft is around $24. Basically lunch, only because your paycheck hasn't cleared yet. Then you get hit with a fee that can cost more than what you actually bought, like you took out a loan you never asked for. And if that overdraft sits for 3 days, the effective APR math can shoot past 16,000%. That number isn't there to educate you. It's there to reveal how expensive no cushion really is. Last year, about 34% of households earning under $65,000 got hit with overdraft fees, while households over $175,000 were closer to 10%. The less you have, the more you pay. And that isn't personal failure. It's engineered. But overdrafts are just the appetizer. In the struggle tier, there's a whole buffet of products designed to catch you when you panic. And the most famous one is the payday loan. It's marketed as quick cash for emergencies, but it behaves like financial quicksand. The more you move, the deeper you sink. The average payday loan APR often sits around 391 to 400%, which sounds fake until you realize it's normal. A loan around $375 can cost over $520 in fees, and only about 14% of borrowers can actually repay on time. So what happens next is predictable. They roll the loan again and again, because not rolling it feels like suffocation. 1 in 4 payday loans gets rolled over 9 times or more, and a $500 emergency can inflate into $2,000 of debt within months. This is how the system keeps people stuck in Tier 1, by turning emergencies into recurring fees. Then we get to auto loans, which sound normal. But in Tier 1, they can feel like a sentence. If your credit score is under 600, you might see 15 to 21% APR on a used car. Meanwhile, someone with good credit might pay 5 to 7%, meaning the same car becomes far more expensive simply because you're placed in the easy-to-monetize category on a $30,000 car loan. That difference can look like about $4,000 in total interest versus nearly $13,000. Basically a $9,000 penalty for being poor. And then there are store credit cards, the sweetest trap. They offer 15% off today, and it feels like saving. But the APR can sit above 30%, like 30.14. Deferred interest promotions can be even nastier. Miss one payment, and they hit you with retroactive interest on the entire original balance. You thought you were getting a discount, but you just signed up for a punishment clause. Even if you avoid those products, being unbanked still has a price tag. When you rely on check cashing, prepaid cards, and money orders, small fees repeat until they can become around $3,000 a year. Over 30 years, that's $90,000 in direct cost. And if that money had been invested instead of leaking out, it could become roughly $300,000 in lost wealth. You're paying a poverty tax just to access your own money. And that's why this is a tiered system. The bottom tier pays fees, so the top tier can enjoy free banking. But once you cross $30,000 in net worth, the game starts to shift. Banks become slightly less hostile, and they sell it with premium-sounding names. In the next part, we move into Tier 2, where you think you've been upgraded. But there's a quiet trap hiding under the word perks. Now 4. Tier 2 runs from $30,000 to $1 million in net worth. I call it the middle-class upgrade tier. Banks become slightly less hostile here. They stop treating you like a fee machine and start speaking in softer language. You'll get invited into programs with fancy names like Preferred, Priority, and Rewards. Like you just leveled up inside a game you didn't know you were playing, but you need to stay sharp. Because this is the tier where banks learn to make you feel valued, while still taking money from you in a quieter, more sophisticated way. This tier doesn't rely as much on obvious punishments like overdrafts. Instead, it uses perks as camouflage. They waive a few small things, and in return, they want you to keep your money where they want it, the way they want it. And the moment you feel proud that you qualify, you're more likely to forget the only question that matters. How much am I gaining, and how much am I giving up? In the next part, I'll show you a concrete example so you can feel how a perk can be a hidden trade. Take a popular rewards program as an example. Some banks start letting you in around $20,000 in combined balances. They label you gold, which sounds like real gold. But the early benefits are usually modest. Something like a 25% boost in credit card rewards and about $200 off certain mortgage-related fees. If your card earns 1.5% cash back, Gold might turn that into 1.875%. It looks cleaner on paper, but it's not magic. You're getting the feeling of winning while you're really just getting a few extra dollars per hundred spent. Then at around $50,000, you may hit Platinum, where the reward bonus could jump to about 50%. At around $100,000, Platinum Honors might offer a 75% boost, turning 1.5 into 2.625. That can actually matter if you spend a lot. But this is exactly where banks want your attention. They show you the plus sign, and they hide the minus sign behind another door. In the next part, we open that door by looking at what you're sacrificing to keep those perks. Well, Lis Paytas was at higher thresholds. The whole thing starts to feel like a club, around $150,000. Some banks offer a private client tier, a dedicated banker, free global ATM access, and sometimes a small discount on auto loans, like 0.25%, around $200,000. Other programs add wealth advisors and even lifestyle perks like museum passes. So you feel like you've entered a more refined layer of society, around $250,000. You'll hear terms like relationship pricing on mortgages, as if you and the bank are long-term partners. But here's the trap nobody highlights. Many banks pay almost nothing on those park balances. Something like 0.01%. If you keep 50,000 sitting there at that rate, instead of earning around 4% in a high-yield account, you could lose roughly $2,000 a year in interest. And very often, that lost interest is worth more than the rewards boost you're celebrating. You're not getting preferred treatment for free. You're paying with opportunity cost. In the next part, I'll say it plainly. Rewards aren't just a fun game. They can function as a wealth transfer from the weak to the strong. Rewards cards sound like the bank is giving you a gift, but in reality, they can work like a pump that moves money upstream. Research suggests rewards programs can shift about $15.1 billion a year from lower credit score consumers to higher score consumers. People with scores above 780 can earn close to $950 in benefits per card and save about $710 in interest because they pay on time and avoid penalties. Meanwhile, subprime consumers may earn much less, around $180, while paying about $640 more in interest. That's the truth. The gift is financed by people who can't afford to play the game perfectly, and similar patterns show up in mortgages. Overall, approval might sit around 81%, but denial rates can look very different, with Black applicants around 21%, Hispanic applicants around 17%, and white applicants around 11%, even when income levels overlap. The relationship discounts that actually matter, like shaving 0.125 to 0.375 off a HELOC rate, often require maintaining 20,000 to 100,000 in balances. So, to access cheaper money, you already need spare money sitting still. In the next part, we enter Tier 3, where banks don't just change tone, they change the rules. Tier 3 is above $1 million in net worth. And this is where banking turns into a different sport. At 1 million, you might get a dedicated wealth management team, premium cards with concierge services, hotel upgrades, subscription rebates, perks that sound like a different planet to people below. But that's still the outer gate. True private banking often starts much higher, 5 million, 10 million, depending on the institution. And once you're inside that universe, the most valuable thing isn't free coffee. It's access to borrowing in a way most people don't even realize exists. This is where you see borrowing against your investment portfolio without selling. You don't liquidate. You don't trigger capital gains taxes. You don't lose your positions. You simply use your wealth as collateral and pull cash at lower rates, often around 4 to 6%. While regular people might pay 9 to 11% on personal loans and 12 to 16% on credit cards, the wealthy are borrowing at roughly half the cost. And that's how a famous strategy becomes possible: living on borrowed money while your assets keep growing. In the next part, I'll break that strategy down, step by step. The biggest difference in the VIP tier isn't that they get greeted more politely. It's that they're allowed to play a completely different tax game. They buy assets that appreciate over time. And then they avoid selling, because selling is when taxes show up. Instead, they borrow against those assets at 4 to 6% and use the cash to fund life. Borrowed money isn't treated like income, so it often avoids income tax. Then when they die, the assets can be reset to current value for tax purposes, which can erase the accumulated gains that built up during their lifetime. The heirs may be able to sell with far less capital gains tax than you'd expect. It sounds like a loophole, but it has existed long enough that you have to call it what it is: a system built for people rich enough to afford the right attorneys. And it isn't just taxes. The wealthy also get access to investment doors most people can't enter. To access certain private funds, private equity, or pre-IPO deals, you often need to qualify as an accredited investor, usually around $1 million in net worth or about $200,000 in annual income. Only a small slice of households qualify, yet they control a huge portion of private wealth, so the opportunities flow toward them too. There's another quiet shift as well. Many companies now stay private longer than they used to, meaning the strongest growth phase happens in closed markets that regular investors can't touch. By the time the stock finally goes public and you're allowed to buy it, a big portion of the upside has already been captured. The wealthy don't just get better service, they get access to entirely different financial instruments and timelines. So, who ends up in which tier isn't random, because wealth gaps push people into different banking classes from the start. Median net worth for white families sits around $285,000. For Asian families, it's around $536,000. For Hispanic families, it's around $62,000. And for black families, it's around $45,000. That means the median black household holds roughly 15% of the wealth of the median white household. And that maps directly onto whether you get fees waived or fees stacked. At the top end, the share of households reaching millionaire status is much higher for some groups. At the lower end, the share of households that are completely unbanked is also much higher in some communities, which means they get penalized just to access basic money services. Even when the percentage growth looks better for the weaker starting point, the dollar gap can still widen because the starting line was so far apart. The tiers aren't only about money, they're about who gets to build wealth and who gets wealth extracted. To see how dark this becomes over a lifetime, picture two people earning the same $50,000 a year, but living in two different tiers. One has a $20,000 savings cushion and a 750 credit score. The other lives paycheck to paycheck with a 620 score. And each year they can lose over $2,300 to overdrafts, maintenance fees, higher auto loan costs, higher credit card interest, and random ATM fees over 30 years. That's about $70,000 gone in direct costs. And if that money had been invested instead of extracted, the opportunity loss can reach around $200,000. Same income, different tier, different life. So what do? You learn the thresholds banks use to change how they treat you. You consider lower fee options like credit unions. You stay away from 400% payday loans. You build a cushion. Even $1,000 changes the game. And you actively recheck your rates as your credit improves because banks won't call you to offer better terms. I'm Miles, and this channel is still new, so your subscription genuinely helps. If this video helped you see the banking tiers you couldn't see before, please subscribe and comment which tier you think you're in right now. Thanks for watching, and I'll see you in the next video.